Intermediate Accounting, Chapter 12, Intangible Assets and Goodwill. Chapter 12, Intangible Assets and Goodwill, 1 of 2. After studying this chapter, you should be able to 1. Understand the importance of goodwill and intangible assets from a business perspective and describe their characteristics. 2. Identify and apply the recognition and measurement requirements for purchased intangible assets. 3. Identify and apply the recognition and measurement requirements for internally developed intangible assets. 4. Explain how intangible assets are accounted for after initial recognition. And 5. Identify and explain the accounting for specific types of intangible assets. Chapter 12, Intangible Assets and Goodwill, 2 of 2. 6. Explain and account for impairment and derecognition of limited life and indefinite life intangible assets. 7. Explain how goodwill is measured and accounted for after acquisition. 8. Explain and account for impairment of goodwill. 9. Identify the types of disclosure requirements for intangible assets and goodwill and explain the issues in analyzing these assets. 10. Identify differences in accounting between IFRS and ASPE. Intangible assets and goodwill. The business importance and characteristics of goodwill and intangible assets. Characteristics of goodwill. Characteristics of intangible assets. Recognition and measurement of intangible assets. Recognition and measurement at acquisition. Recognition and measurement of internally developed intangible assets. Recognition and measurement of intangible assets after acquisition. Specific intangibles. Impairment and derecognition. Impairment of limited life intangibles. Impairment of indefinite life intangibles. Derecognition. Goodwill. Recognition and measurement of goodwill. Internally generated goodwill. Purchased goodwill. Bargain purchase, valuation after acquisition, impairment of goodwill. Presentation, disclosure, and analysis. Presentation and disclosure, analysis. IFRS ASPE comparison. A comparison of IFRS and ASPE looking ahead. The business importance of goodwill and intangible assets. More companies are information and service orientated. More of their major assets are intangible. Identifying and measuring intangible assets tends to be difficult, so many intangibles are not captured on company statements of financial position. Although the true value of intangible assets is often not reflected on company financial statements, it does not mean that companies should ignore these assets. Intangible assets provide future economic benefits, selling products and services, reducing costs, etc., and impact profitability. Characteristics of goodwill. Goodwill is an asset representing the future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. Goodwill equals the difference between the fair value of the consideration transferred to acquire a business and the fair value amounts assigned to the identifiable net assets. It can only be recognized when a business is acquired. It can only be sold when a business is sold. It cannot be recognized separately because it cannot be separated from the entity in order to exchange it with others, for example, brand image. Cannot be controlled through contractual or legal rights, example, synergies of a combined sales team. Characteristics of intangible assets, 1 of 2. Intangible assets are identifiable non-monetary assets that lack physical substance. 1. Intangible assets are identifiable, results from contractual or other legal rights. Companies can control access to future benefits and ability to restrict others' access. Enter into exchange transactions, sold, rented, exchanged, transferred, or licensed. Intangible assets lack physical substance. Value comes from the rights and privileges granted to the company using them. 3. Intangible assets are non-monetary, do not contain any right or claim to receive fixed or determinable amounts of money in the future. Characteristics of intangible assets 2 of 2. Intangibles that have similar characteristics, continuity, stability, risk, are grouped and recognized together. If an intangible component is needed for a physical component to work, it is recognized as property, plant, and equipment. If it is not an integral part of the physical object, then classified as intangible. Intangible assets provide economic benefits over more than one period, normally classified as long-term assets. Examples: patents, copyrights, franchises or licensing agreements, trademarks or trade names, secret formulas, computer software, technological know-how, prepayments, and some development costs. Recognition and measurement of intangible assets at acquisition. Recognition criteria the same as for property, plant, and equipment. 2 recognition criteria. 1. Probable future economic benefit, and 2. Assets' costs can be measured reliably, measured at cost at acquisition. Intangible assets may be purchased outright, acquired as part of a business combination, or developed internally. Purchased intangibles 1 of 3. Intangible assets purchased from another party are measured at cost. Includes the acquisition cost and all expenditures directly associated with making the intangible ready for its intended use. Costs not capitalized are those related to product introduction and promotion, conducting business in a new location or with new types of customers, and administration and general overhead. Expenditures incurred after the asset is ready for use as intended and initial operating losses are also excluded. When intangibles are acquired in a business combination, net assets of controlling shares, only those that are identifiable can be separately recognized at fair value. The rest are considered goodwill. All assets acquired in a business combination are recognized even though they may have been internally generated. Purchased intangibles 2 of 3. When several intangibles are purchased together, a basket purchase, the cost has to be allocated to each intangible based on its relative fair value. If there are delayed payment terms, any portion of the payments that represents interest is recognized as a financing expense. If acquired for shares, cost is generally measured at assets fair value, or fair value of shares if value of asset cannot be determined. If intangible assets are exchanged for non-monetary assets, the fair value of the item given up or the fair value of the intangible received is used to determine cost. Purchased intangibles 3 of 3. If the intangible is acquired via a government grant, fair value establishes the book cost, although IFRS does permit a zero or nominal cost in this case. A prepayment is recognized as an asset only when an entity pays for goods before their delivery, or other right of access, or for services before receiving those services. Intangibles that are purchased from another party, a lease for a favorable price, a subscription list, patents, copyrights, franchises, licensing agreements, trademarks or trade names, secret formulas, computer software, prepayments. Intangibles that are acquired through a business combination, internally generated, like brand names, patents, customer relations, in-process research and development. Recognition and measurement of internally developed intangible assets. Companies incur costs internally to create intangibles, such as patents and brand names. Internally developed intangibles present significant challenges. Recognition, when to recognize. Is there probability of future cash flows? Measurement, what costs to capitalize versus expense? How to reliably measure the costs? IFRS allows costs to be capitalized when certain criteria are met, can also be used under ASPE, otherwise costs are expensed. ASPE allows for an accounting policy option to expense all costs relating to internally generated intangibles. Identifying research and development phase activities, 1 of 2. To deal with recognition and measurement uncertainties with internally generated intangibles, the process of generating the intangible assets is broken down into 2 phases. Research activities involves planned searches or critical investigation aimed at discovery of new scientific or technical knowledge and better understanding. It may or may not be directed towards a specific project. Development activities. Translation of research findings or other knowledge into a plan or design for a new product, process, system, service before starting production or use. Identifying research and development phase activities, 2 of 2. If there is uncertainty about which phase a particular activity relates to, it would be classified as a research phase activity. Activities in the research stage: obtaining new knowledge, searching for, evaluating, and selecting ways to use research findings or knowledge, investigating possible alternatives for existing materials, products, processes, systems, and services, formulating, designing, evaluating, and choosing possible alternatives for new or existing materials, products, processes, systems, and services. Activities in the development stage: designing, constructing, and testing prototypes and models prior to production or use, designing tools, jigs, molds, and dies involving new technology, designing, constructing, and operating pilot plants that are not economically feasible for commercial production, designing, constructing, and testing chosen alternatives for new or improved materials, products, processes, systems, and services. Accounting for research and development phase costs, 1 of 3. Research phase costs. Costs incurred for research or during the research phase of an internal project do not meet the criteria for recognition as an intangible asset. Costs are recognized as expenses when they are incurred. With development phase costs, capitalized costs only if 6 specific conditions see below are met, and only when the future benefits are reasonably certain. Recognized only in limited situations because it cannot happen until all 6 criteria are met. Costs incurred that cannot be distinguished from general business development costs are excluded. Brands, mastheads, publishing titles, customer lists. Accounting for research and development phase costs, 2 of 3. An intangible asset can be recognized from the development stage of an internal project if the company can demonstrate technical and financial feasibility, show intent and ability to generate future economic benefits, meet all 6 of the following conditions. 1. Technical feasibility of completion. 2. Intention to complete for use or sale. 3. Ability to use or sell it. 4. Availability of resources to complete it, use it, or sell it. 5. Show how future economic benefits will be generated, existence of a market or usefulness to the company. And 6. Ability to reliably measure costs. Accounting for research and development phase costs, 3 of 3. Development costs begin to accumulate after all 6 criteria are met. Include all directly attributable costs needed to create, produce, and prepare the asset for use. Examples: costs include materials and services used or consumed, direct costs of personnel, fees needed to register a legal right, amortization of other intangibles needed to generate, interest of borrowing costs, costs excluded. Selling, administrative, general overhead not directly linked to the process, costs to train employees, initial operating losses, legal and other costs of incorporation, pre-opening costs, relocation and reorganization costs, advertising and promotional activities. Recognition and measurement of intangible assets after acquisition, 1 of 3. 2 models for measuring intangible assets after acquisition. The cost model, most widely used only method under ASPE, and the revaluation model, applied only to assets that have a fair value determined in an active market. Both models are applied in the same way as for property, plant, and equipment, see Chapter 10. When revaluation model is used, all assets in the same class must apply the same method. There's no requirement for annual revaluation as long as its reported carrying amount is close to fair value. Recognition and measurement of intangible assets after acquisition, 2 of 3. 2 different lives for intangibles, those with a finite, limited useful life, and those with an indefinite life does not mean infinite, no foreseeable limit to its usefulness. Amortization for limited life intangibles, amortized over its useful life, carrying amount less residual value, assumed to be 0 unless there is a commitment to purchase or an active market. Useful life determined by expected use of the asset by the entity, limitations of legal, regulatory, or contractual provisions, effects of obsolescence, demand, competition, economic factors, level of future maintenance expenditures. Recognition and measurement of intangible assets after acquisition, 3 of 3. Amortization for limited life intangibles continued. Should reflect the pattern in which the benefits are used up. If no obvious pattern, straight line method is used. Cannot use revenue-based method. Debit expense or inventory, credit accumulated amortization. Amortization for indefinite life intangibles. An indefinite life intangible is not amortized. Because of the potential effect on the financial statements, it is important for management to review whether the intangible asset still has an indefinite life. Required every accounting period under IFRS, required when circumstances indicate possible impairment under ASPE. Any changes resulting from review are treated as change in estimate, does not affect past results. Specific intangibles, 1 of 4. 5 major categories for intangibles. 1. Marketing-related intangible assets, used in marketing and promotion. Trademarks or trade names. Trademarks and trade names are renewable, so the legal life may be unlimited. The useful life, however, may be limited. Costs of acquired trademarks or trade names are capitalized. If trademarks or trade names are developed by the business, direct costs may be capitalized if all 6 capitalization requirements are met. If the future benefits of a trademark, such as Coca-Cola, are determined to have an indefinite life, it is not amortized. There's also newspaper mastheads, internet domain names, and non-competition agreements. Specific intangibles, 2 of 4. 2. Customer-related intangible assets result from interactions with outside parties. So this could be customer lists, order or production backlogs, contractual and non-contractual customer relationships. 3. Artistic-related intangible assets. Ownership rights to artistic endeavors that are protected by copyrights. Exclusive right of owners and heirs to copy a creative work or allow someone else to. acquired automatically or registered, granted for the life of their creator, plus 50 years, can be sold or assigned but cannot be renewed. Useful life is generally less than the legal life, usually written off over a short period, amortized over period in which benefits accrue. Costs of acquiring and defending copyrights may be capitalized. There's also plays and literary works, musical works, pictures, photographs, video, and audio-visual material. Specific intangibles 3 of 4. Contract-based intangible assets. Value of a right resulting from a contractual agreement. Licensing arrangement or franchise. A franchise is a contractual agreement where franchisor grants the franchisee the rights to sell specified products or services, use certain trademarks or trade names, perform certain functions within a particular geographical area. A franchise may exist for a limited time or for an indefinite period. The cost of a franchise with a limited life is amortized over the lesser of the legal or useful life. The lesser of the legal or useful life. A franchise with an unlimited life is amortized over the expected useful life when such life is deemed limited or it is not amortized. Annual operating payments for a franchise are expensed. Lease agreements. A lease or leasehold is a contractual understanding between a leaseor, property owner, and leasee, property renter, that grants the leasee the right to use specific property, valid for a certain period of time. Leasee makes specific, usually periodic payments, could be considered an intangible asset if the terms are more favorable than the usual market terms for such an agreement. Other contract-based intangibles would include construction permits and broadcast rights. Specific intangibles 4.4. 5. Technology-based intangible assets relate to innovations or technological advances. Product and process patents that are new, workable, or ingenious. A patent gives exclusive right to the holder for making, selling, or using a product or process. Patent rights have a legal life of 20 years from the date the patent application is filed with the Patent Office. Costs of purchasing patents are capitalized, and costs to research and most development costs are expensed as incurred. Patents are amortized over the shorter of the legal life, 20 years, or their useful lives. Legal fees and other costs to successfully defend a patent are capitalized and amortized over the remaining useful life of the patent. Small modifications or additions may lead to a new patent or an extension of the old patent. Unamortized costs from the old patent can be added to the new patent if it provides essentially the same benefits. Computer software costs. Impairment and derecognition, 1 of 4. Impairment of limited life intangibles. Impairment of limited life intangibles is covered by the same impairment models and standards as for long-lived tangible assets. Potential impairment is assessed under ASPE when events or circumstances indicate that carrying value may not be recoverable. Under IFRS at the end of each reporting period. Remember, the two impairment models are cost recovery impairment model for ASPE and rational entity impairment model under IFRS. Impairment and derecognition 2 of 4, review of the impairment models from Chapter 11. Concept, the cost recovery. Assume carrying amount is recoverable through undiscounted cash flows from future use and sale. The rational entity assumes management will use the asset or dispose of it, whichever results in the higher return. The recoverability test for the cost recovery model is if carrying amount is greater than the undiscounted cash flows. The rational entity model, impaired if carrying amount is greater the higher of the two options. Loss on impairment for cost recovery is the carrying amount minus the fair value, and the loss on impairment on the rational entity model is the difference between the carrying amount and recoverable amount. And the recoverable amount is measured as higher value in use, which is the present value of future net cash flows, and fair value less cost to sell. Reversal of the loss is not allowed under the cost recovery model, but under the rational entity model, reversal of loss if estimates underlying recoverable amount has changed. Amount is limited. And subsequent amortization under the cost recovery model, review depreciable amount, useful life, and amortization, determine new amortization change. And the same with the rational entity model. Impairment and derecognition 3 of 4, impairment of indefinite life intangibles. Under ASPE, impairment test is the fair value test. If fair value is less than the carrying amount, recognize loss on impairment. Under IFRS, impairment testing is done on an annual basis. Under ASPE, recoverability test is based on undiscounted cash flows, is invalid because the undiscounted cash flows over a long period of time are considerably higher than the present value, so they are not comparable. Under IFRS, compare carrying value and recoverable amount on an annual basis, whether or not there is an indication of impairment. So both methods of impairment under ASPE and IFRS are very similar, except for the two differences I just explained below. Impairment and derecognition 4.4. Derecognition. Required when the intangible is disposed of. Continuing use or disposal is not expected to generate future economic benefits. Gain or loss is recognized, equal to the difference between the carrying amount and the proceeds on disposal. Gain or loss on disposal is recognized in income. Goodwill, recognition, and measurement. Internally generated goodwill is not capitalized. Future benefits may not have any relation to the costs, or goodwill may exist with no expenditures to develop it. It's very open to subjectivity or misrepresentation. Goodwill is recognized only when a business combination occurs, which is a purchase, because the value of goodwill cannot be separated from the business as a whole. The purchase price is allocated to identifiable intangible assets, and the difference between the fair value and the carrying amount, which is the residual, is assigned to goodwill. Goodwill, recognition, and measurement. Purchase goodwill example 1 of 2. The following business was purchased for $400,000, and at that time the fair values were listed on December 31st, 2020 for a total of $350,000. Goodwill, recognition, and measurement. Purchase goodwill example 2 of 2. Determination of goodwill. So you take your fair value of consideration transferred, which is $400,000, and then less your fair value of identifiable net assets. So that's the fair value of the cash, accounts receivable, inventories, property, plant, and equipment, patents, and liabilities. And there was no other net identifiable assets. And so then the value assigned to goodwill is $50,000. So when you record the journal entry, you debit cash for the fair value, the accounts receivable, the inventory, the property, plant, and equipment, intangible assets for the patents, and the goodwill. So that's your debit. And then you're going to credit the liabilities, and you're going to credit the cash for $400,000, which is what you paid. Goodwill, recognition, and measurement, bargain purchase. A bargain purchase, or negative goodwill, arises when fair value of acquired identifiable net assets is greater than the fair value of consideration exchanged for those assets. Market imperfection, questionable business decision by the seller. Seller might be better off selling the assets individually. The current standard requires any negative goodwill be recognized immediately as a gain in net income after a thorough reassessment of the variables used in determining its amount. Goodwill valuation after acquisition. Goodwill acquired in a business combination is now considered to have an indefinite life and is no longer amortized. It's carried on the statement of financial position at the amount originally recognized in the combination less any subsequent impairment losses. Income statements are not charged with any amounts paid for the goodwill unless the asset is considered impaired. Goodwill impairment. Because goodwill is not identifiable and does not generate its own direct cash flows, it is assigned to a reporting or cash generating unit, CGU, in order to be tested for impairment. Other than this specific requirement, impairment accounting for goodwill is similar to that of intangibles with an indefinite life. Impairment of goodwill. Under ASPE, apply impairment test when events or changes in circumstances indicate, IFRS, annually, and whenever there is an indication that the CGU may be impaired. At acquisition date, assign goodwill under ASPE to a reporting unit, an operating segment or one level below. IFRS to cash generating unit, smallest identifiable group of assets where goodwill is monitored for management purposes and no larger than an operating segment. There is an impairment loss under ASPE when carrying amount of reporting unit included goodwill is greater than the fair value of reporting unit. Loss equals amount of excess. Under IFRS, it's when carrying amount of the CGU including goodwill is greater than the recoverable amount. Loss equals the amount of excess. Recoverable amount is the higher of the value in use and the fair value less cost to sell. Impairment loss is allocated under ASPE to goodwill as a goodwill impairment loss. Impairment test for other assets and group is done before goodwill impairment test. Under IFRS, first to goodwill related to the CGU, then remainder to other assets on a relative carrying amount, which is a proportionate basis. Goodwill impairment reversal is not permitted under both ASPE and IFRS. Goodwill impairment example. Reporting unit under ASPE and a CGU under IFRS. So under A, the loss on impairment under ASPE is take the carrying amount of the unit of $2.4 million, subtract the fair value of the unit for $1.9 million, and you have the difference, which is a goodwill loss on impairment. So you do the journal entry for debit loss on impairment, $500,000, and credit accumulated impairment losses goodwill, $500,000. B, the loss on impairment under IFRS is the recoverable amount, which is the higher of the two amounts of $2.1 million. Now you take your carrying amount of the unit of $2.4 million and the recoverable amount of $2.1 million, and the difference is the goodwill loss on impairment, $300,000. So in this case, you'd make the same journal entry, except the value would be $300,000, not $500,000. Requirement to report the gross amount of goodwill and accumulated impairment losses separately. Goodwill account is not credited. Presentation and disclosure, one of two. While there are few required disclosures on the face of the statement of financial position and the statement of comprehensive income, a significant amount of information is required in the notes to the financial statements, particularly those prepared under IFRS. For each class of intangible asset, separately for internally generated intangibles and other intangible assets, some of the disclosures required are whether their lives are indefinite or finite, limited, useful life, methods and rates of amortization, the carrying amount of intangible assets with an indefinite life, a reconciliation of the opening and ending balances of their carrying amount, and accumulated amortization and losses on impairment. Losses on impairment and reversals of losses on impairment. Presentation and disclosure 2 of 2. For each material loss on impairment recognized or reversed in the period, the following is required: the circumstances that led to its recognition, the amount recognized, the nature of the asset or cash generating unit, and information about how the recoverable amount was determined. For each cash generating unit or group of units that has a significant amount of goodwill or intangible assets with an indefinite life, the following is required: how the unit's recoverable amount was determined and underlying assumptions. For intangible assets measured using the revaluation model, their carrying amount, the carrying amounts if the revaluation model had not been applied, the date of the revaluation, the amount of the associated revaluation surplus, and changes in that account. The methods and assumptions used in estimating fair values. Analysis. Financial accounting does not capture and report some assets that contribute to future cash flows. The missing values belong to unrecognized, internally developed intangible assets known as knowledge assets or intellectual capital. Companies increasingly disclose more of this soft information outside the financial statements. Other intangibles are recognized, but with a relatively high level of measurement uncertainty. Care must be taken when analyzing financial statement information related to earnings and total assets. IFRS and ASPE comparison. There are a few but significant differences between ASPE and IFRS regarding intangible assets and goodwill. Accounting treatment of costs incurred in the development phase of internally generated intangible assets that meet the 6 stringent criteria for capitalization. Under IFRS, costs are capitalized. Under ASPE, entities can choose to capitalize or expense the costs. The impairment model is applied. Under IFRS, the rational entity model is used, and under ASPE, the cost recovery model is used. Reversal of impairment losses. Under IFRS, allowed for intangible assets, but not for goodwill. Under ASPE, it's not allowed for intangible assets or for goodwill. Looking ahead, the IASB has tentatively decided not to consider reintroducing amortization of goodwill. However, it was considering ways of ensuring that impairment of goodwill is recognized on a timely basis. The end.